Topic 14b, NPV and WACC for projects with differing business risk and capital structure than the parent firm. Copyright Lou Gaddis. In this topic, we'll calculate the NPV and WACC for projects that have different business risk and capital structure than the existing or parent firm. To do that, we're going to calculate levered and unlevered betas, and then use that to calculate NPV and WACC. So here's a simple NPV from the last section that calculated the NPV of a project from Apple that had the same risk as far as business risk and same capital structure as Apple itself. So this is when Apple might have been looking at launching a mini iPad. So it already had an iPad business. It had a lot of electronics in it. So we figured this business would have similar business risk as the existing firm. This project is also going to be financed using the firm's capital structure of 90-10 equity and debt. So to do that, we calculate the weighted average cost of capital using the firm's existing 90-10 equity debt structure. Use CAPM to calculate the NPV, or the cost of equity, risk-free rate plus beta times market risk premium. Calculated cost of debt, which we use the risk-free rate of 3% plus a 2% spread for Apple risk. And we subtracted the tax to get the weighted average cost of capital, 8.85%. The free cash flows in this example were the earnings after tax, adding back depreciation, subtracting both working capital changes and CapEx. And then we calculate the NPV, discounted at WACC, and got negative $5 million, so they should not do the project. However, Apple then proposes something interesting. They say, well, how would the project look differently if we finance it using more debt? Well, you might think that if the firm issues more debt, that's going to affect the beta of the project. You assume that would be higher. It would also affect the credit spread. If bonds were issued to, say, finance this project, that spread would be a little bit higher. And we'd also have new ratios of debt and equity. So to calculate this first number, what would happen to the beta of this new project? We're going to do something called unlevering and levering a beta. So the basic idea is that if you want to finance a new project that has the same leverage as the existing firm, you could use the firm's existing beta that you'd get from the internet, so Yahoo Finance or Google Finance, or do your own regression. However, if the project has different risk, what you could do is take the firm's levered beta, which is the one you find on all these websites or calculate yourself, right? It's just the beta of the firm with its existing leverage meaning debt. And then you'll unlever it by dividing by 1 plus the after-tax debt-to-equity ratio. And if you check the textbook, you can see the derivation of this formula. But the idea is you're reducing the beta for the debt-to-equity ratio. This would give you the unlevered beta of the firm. So this would be presumably Apple's beta. If I plugged in Apple's beta here and Apple's debt and equity ratio and tax rate here, this would be the beta of Apple if they issued no debt. So a debt-free, unlevered beta for Apple. And then the project would have similar business risk as Apple, but we're going to re-lever it using the project or the investment's debt-to-equity ratio and investment tax rate. Once I get that new beta, I then plug that into the cost of equity formula, CAPM, and then I'll have a new cost of equity for this project. And then for the debt, I presumably, if I issue more debt, I'll also have a higher credit spread. So I'll look up and see, well, at that debt-to-equity ratio, what rating would that project have, say, standalone? Say that project might have a triple B rating or a single B rating based on that debt-to-equity ratio and some other coverage ratios, and I get a new debt spread. Then I'll just plug those into the cost of debt and the new cost of equity into the WACC formula, and I'll get a WACC for the project. So here's the example again we did. The beta of Apple's 1.3 and a debt spread of 2%. So we use the firm's Apple's weighted average cost of capital to evaluate the mini iPad. However, what if they wanted to finance the project using 65% equity and 35% debt? And they estimate the credit spread will go to 2.5. In other words, go from 2 to 2.5. This would go to 65% and 35%. And then the only question is, well, what happens to the beta for the project? Well, what I'll do is I'll take Apple's existing beta 1.3, delever it by dividing by 1 plus the after-tax debt-to-equity ratio of Apple, and see that if Apple had no debt, they'd have a beta of 1.22. And then I would relever that beta using the project's debt-to-equity ratio and tax, and I'd see that the project as a standalone would have a beta of 161. And then I'll plug the 161 into CAPM along with the 65%, 35% of debt, and then the new debt spread of 2.5%. And I get a project WACC of 834 versus 885. So the WACC has fallen as we increase the debt. And this is a common thing that you might see. For a firm that has, it's very safe, no probability of a near-term collapse like Apple, and very little debt, you could actually decrease the WACC of the firm by issuing a little more debt, because by doing so, you're going to get a more advantage of that tax shield. And since the cost of debt does not increase materially, in other words, you really haven't affected that much the cost or the likelihood of this firm defaulting, you could actually increase value in the project just by financing it with more debt. In this case, the NPV goes from -5 to -0.5, almost breaking even. So in this case, debt is good. A little bit of debt is good, I should say. A little bit of debt can increase the value of a firm by maximizing, or at least increasing, the tax advantage of debt. So that's what I do if I had to evaluate a project. I had the same business risk, in other words, the same business line as the existing firm, but a new capital structure. However, what if Apple wanted to get into a new business that had totally different risk than their existing business line, which is, say, electronics, consumer electronics? Say it's a brand new product in a different area, a new industry, new production types, a new location globally. That's what actually next topic is going to be about. What we'll do in this case is actually we'll borrow another firm's beta. So for example, what if Apple's considering an investment in the cable television business? Well, the cash flows are given and you're trying to calculate an NPV. So you have certain cash flows which are given, and now you need to calculate an NPV, which then requires a weighted average cost of capital. Well, in this case, I'm not just going to use Apple's beta to calculate the cost of equity. Because if I do that, that beta already reflects the risks of, say, consumer electronics business. So what I can do is I want to actually calculate the unlevered beta of a cable firm, or maybe the cable industry, use that unlevered beta for that business unit, and then lever it using the project, Apple's projected debt-to-equity ratio. So we call this using a proxy beta. That if you're going to move into a different area, just find a firm that operates in this area, calculate their beta, use that in CAPM with your capital structure, and then you can figure out the required cost of equity for that business. So in this example, what we're doing was we're going to take the cable industry's beta, D/E, and tax rate, or maybe even just a big competitor like Comcast. Use that and calculate an unlevered beta. So the unlevered beta for the cable industry would just be the levered beta over 1 minus the after-tax D/E, so an unlevered beta of 0.879. So if this industry had no debt, or this, say, firm had no debt, it would have a lower beta of 0.879. And then we'll lever that beta up for cable using Apple's capital structure. So 879, I'm going to lever the beta, multiplying times the after-tax cost of capital. I'm sorry, after-tax D/E. and I get a beta of 0.94 for Apple in cable business. And then I plug in my CAPM formula and calculate the cost of capital. The risk-free rate is 3%. The market risk premium in this case is 8 minus 3, and the beta is 0.94. So it would be 0.94 times the market risk premium of 8 minus 3, or 5. And I get a 7.7% cost of equity, which is close, rounds up to 8 in this example. And I'd use that to calculate the NPV and WACC of the cable investment. So in this topic, we looked at how to value domestic investments with business risk and capital structure that differs from the parent firm. We did that by levering and unlevering firm betas, or unlevering and then relevering proxy betas. The next topic, we'll calculate NPVs using terminal values. That is free cash flow multiples and growth perpetuities.